Hello, everybody, and welcome to the show today. I'm really glad you could join us. So today we have a very special guest that's going to teach us all kinds of things about life insurance policies, what you don't know, what you need to know, and how you can use these as a very, very, very valuable vehicle to do, well, all kinds of cool things. But I don't want to give you too much info, so let me introduce our special guest. Jerry Fetta actually helps people unconfuse their money so they don't lose their money, so that they can use their money to build wealth now. Okay, as the founder and CEO of Wealth Dynamics, a wealth creation firm that helps clients across the U.S. build wealth, Jerry has a passion for providing financial education for families that cause them to build wealth and navigate their economic futures with certainty. Now, Jerry's married to his wife and business partner, Lexi, and together they have taken Wealth Dynamics from nothing to a multi-million-dollar company over the last 4 years. Jerry, thanks for joining us today.
Yeah, thank you so much for having me on, Ty. It's really a pleasure.
Well, I'm really glad you could be here because there's so many things about life insurance that I don't know and that a lot of people don't know. As a matter of fact, somebody just actually asked me a question about that today. I wish they would ask you about that tomorrow. I'd probably be able to answer it. But anyways, I'm glad that you're here to help us answer all these questions. So again, man, thanks for carving out the time. So Jerry, let me ask you, starting from
Definitely, I'm glad to be here.
So let's start from the beginning. How does somebody utilize a life insurance policy, then lets them earn compounding interest of 3-5% a year? I kind of seen you talk on that topic. That seems pretty interesting to me.
Yeah, so it's definitely an interesting topic, and it's something that it's not very well known about. If you look back historically, it's been used for over 150 years now. And so the short answer is it's a specific structure of a whole life insurance contract. So it's this permanent insurance policy that a lot of banks, Fortune 500 corporations utilize. And when you set it up correctly, it can be used as a savings vehicle. It can earn that compounding interest you talked about, and it can be leveraged against to be able to use for passive income investing, debt pay down, and a plethora of other things simultaneously.
So this is where I think a lot of people get confused, right? Because I think general people that don't have a lot of education on this topic think about life insurance as life insurance. They think about, if something happens and unfortunately you pass away, that somebody in that family then actually receives some kind of financial amount to help them with life without you. But sounds like these can be really used as a vehicle for saving and earning a return. So how do we go from somebody that has very little to no knowledge of life insurance? And how do we teach about how this actually works, where it's not just if something happens to you, you've got money coming in for your family, but actually using this legitimately as a savings or retirement vehicle?
Yeah, that's a really good question. And it lines up really well. I used to be on that side of the fence. Are you familiar with like Dave Ramsey and kind of what he does
Sure.
in the financial industry? So I was a Dave Ramsey guy for probably 5 or 6 years. And if anyone knows Dave Ramsey, they know he's totally against using life insurance as a savings. So that was my mindset at that time. It was very much life insurance is just for a death benefit. It's not for investing. It's not where you would keep money at. And so the that I had was to how somebody puts a policy. There's a lot of customization that can happen. And so essentially, the idea would be, when I save money, I've got to look at what's the purpose. What am I saving for? And a lot of us don't have that figured out. If we start thinking about what is the savings going to be utilized for me, ideally it's utilized for investing. Money that would grow and produce passive income. Now, while out, there's this big question of what's it doing while it's accumulating. And so with the life insurance, I'm able to have it accumulating at that 3 to 5% interest rate, which is great. Now, the average person, they're going to use either a bank or they're going to use a 401k or something of that nature, right? And so essentially what we're looking at is while you have it there, you've got to have it growing. You've got to also have it liquid. So it can't be something that's locked up till I'm 60. So the life insurance is something that grows at 3 to 5%. I can use it anytime. If I put in money today, I could pull that money out tomorrow if I really wanted to. And so I've got those 2 boxes checked off. Now, the third thing is, like with any account, when I pull money out of it, it typically doesn't continue to grow, right? If I go to a bank and I deposit money, they're not still going to pay me interest when I take that money out. The life
Right.
insurance is unique in the sense that because of how it's structured, they're still going to pay me my money while I'm using it because of that loan factor, which we can kind of dive into in a little bit here. So the mindset really becomes need to provide maximal growth and maximal liquidity at the same time. And ideally, I'd like to have uninterrupted compounding interest even after I've accessed it.
Makes sense. All right, so we've got Jerry back. So we had a little bit of a technical glitch there, but I think we've got it corrected. So I want to revisit that, Jerry, because I heard parts of it. You had a really good answer about this kind of mindset that people have, where they kind of think of a life insurance policy as something that's there if something happens to them, if they reach, if they unfortunately pass away, but they don't really see this as an investment vehicle. So kind of give me again your standpoints. It sounds like you were a Dave Ramsey fan, where you kind of saw it the same way, but then something switched over. So help us understand how it can be really used as a savings and investment vehicle.
Yeah. So as you said, I was a Dave Ramsey fan, and I was actually an endorsed local provider. So I was actually a professional in the investing world that helped Dave Ramsey listeners with their investments. So anyone that knows Dave knows that he is not a whole life insurance guy. He's a term life, put the money in the stock market type of setup. So that's very much what I was too. And for me, the paradigm shift was a couple of things. The first one was seeing the intention behind saving. And so when I started learning that saving should be money that's set aside to invest for passive income rather than money that's set aside for a nest egg and for emergencies, that was really the first mindset shift, right? So if the dollar is going down in value, which we all know it factually is, then it really comes down to, is that money growing for me while I'm accumulating for my investment? If I'm trying to get 20 or 30 or $40,000 put away to do an investment or a real estate deal or something of that nature, there's a time frame, and that time frame is called accumulation. And during that time frame, I've got to look at, what am I making? And so the average person, they accumulate either in a bank or they accumulate in a retirement account. So in a bank, I'm not getting growth, I have liquidity. In a retirement account, I'm getting growth, I don't have liquidity. How could I have both? And so when I started searching, ironically, I came up with whole life insurance. And so with the life insurance, I've got the growth, which is that 3 to 5% compounding interest rate. And I've got the liquidity aspect of, I can borrow against that policy right away. If I were to put money inside of it today, I could literally have a check in my bank account in the next few days from a policy loan. Now, the third factor, which is kind of an X factor, is, if I put money in a bank and I withdraw that money, the bank's probably not going to still keep paying me interest on my money. I took it out. Same thing with the 401k. And it makes sense. Mathematically, there's no reason why they should. With life insurance, I have the growth and the liquidity, but I also have the aspect that when I borrow against that money, the life insurance company still keeps paying me that 3 to 5% while I simultaneously use my money. And that's huge. That's a factor that banks use when we deposit money with banks. That's the exact same thing they do. Is it's called fractional reserve banking, and basically just lets them multiply on what they have in deposits and leverage that money to grow in more locations than just the one.
Interesting. So then, based on that, you really can use it as a passive saving vehicle.
That's totally true. Yeah. So it's a passive savings vehicle. It accumulates and it can be active. I can tap into that whenever I need to.
And how does that even work? I mean, so, I have a whole life policy. I put $10,000 in it. COVID-19 hits. I need to grab my 10 grand quick. I take my 10 grand out. I'm still earning interest. And then the expectations that I then have to pay that 10 grand back in. And is there parameters of how and when I must do so?
So that's a really good question. So the first thing I want to cover, and this has been excellent during the COVID-19 crisis, a lot of investors in the stock market have lost money. And so these insurance companies that we look at, that's a question, is, are they financially stable during economic downturns? Rule number one, never lose money, right? So the companies we work with, they've been around for over a century and a half. They've paid dividends every single year since then and never once lost money. And so that's during the Civil War, during the Great Depression, the tech bubble, 2008. So I can kind of answer that question for myself on, okay, the money is secure. It's not going to be lost. Now, the liquidity factor during a time like this, if I wanted to take a loan, it's simply me going to the insurance company. And it kind of works like this. If I made, in any given investment, if I made a 3 to 5% return and I pull that out and I gain that money, first thing I've got to look at is the IRS is going to want their cut, right? If it's a gain, they're going to take some, and that's just how life works. Now, I don't particularly like that. I think your average listener probably doesn't either, on, hey, how can I avoid paying taxes if I don't need to? So the arrangement works like this. When I'm a policyholder with an insurance company, I'm actually an equity shareholder as well. So they treat me as an owner of the company. And so what I can do is I can go to them as an owner and I can say, guys, I have 50,000 in my cash value. I just had a 3 to 5% gain. I don't want to pay taxes. So what I would like to do is I would like to borrow 50,000 from you guys, and let's just use my account as collateral. And so that does two things. It circumvents taxes. The IRS can't tax a loan. It's not income or a gain. And the second thing is, because it was a loan, it never actually left the account. So my money's still growing and I'm avoiding the taxes. Now, because I'm an owner, there's no payback terms. Smart thing to do would be pay it back with my cash flow just as a savings function. But technically, if I didn't want to, I wouldn't ever have to pay that money back. And the way that it works is, if I didn't, when I did pass away, my outstanding loan would just be subtracted from my death benefit. So I could leave that loan outstanding. I could pay that back every month. If I invested that 50,000, I'm earning 500 a month in cash flow. Technically, I could throw that back into my policy repayment, but I have a lot of flexibility on that.
Yeah, it sounds like you have a lot of options, so it could really work for you many different ways.
Right. And the benefit is, if I don't pay it back, it's still going to grow. I'm still going to have that 50,000 value growing like it never left.
Well, how do you go about choosing the right at one of these policies? Because it seems like there's so many to choose from.
So that's a great question, Ty. And this really is, in my opinion, the issue in the industry is choosing the right policy, choosing the right company, choosing the right agents, and also choosing the right design. And so when you look at the function, again, what are we trying to accomplish? I always like to keep it simple. What is this tool supposed to do for us? And so when it goes to that question, the first thing that comes up is, policy design. So I've got to make sure that I have a policy that's designed correctly. It's got maximum liquidity, minimal insurance costs, and the highest growth rate that I can get. And so that's the first factor I'm looking at. The second factor is the agent. So I'm looking, again, when I start looking as a consumer, I'm thinking policy design. The first thing I've got to do then is find a professional to design it for me. So I've got to find an agent that's actually educated on how to do that, and they have the right mindset. And that's very hard to come by. A very small percentage of agents in the insurance industry really, to be frank, even know this is a thing and that they can do this with a policy. And another percentage of them just simply won't, because it doesn't pay as well. So the agent has to know their stuff. And then the third thing is, then I have to look at the policy type. It's going to be a certain type of policy. It's called a high early cash value dividend paying whole life insurance policy. And again, that's about one sliver out of dozens of different types of policies out there that somebody could be offered or they could buy. So I have to really make sure that that's the one I get. And then finally is the company. At the end of the day, if this is a guaranteed savings program, the guarantee is only as good as the guarantor. So I like to look at companies that have, 150-year plus track record. They have very high financial ratings, lots of money in reserves. Personally, I have 4 policies, and mine are mostly with New York Life, Guardian, Mass Mutual. And those are usually the big dogs. They have the best track records, the best growth rates.
So you're putting your money, a lot of it, into different whole life policies versus investing like in the stock market.
Right. And this is a totally different conversation. I stay out of the stock market altogether. So I really, when I'm accumulating, I keep that money in a policy until it's ready to be put to work. And a lot of times when it is, it's going to be for, a passive income producing investment that will pay me every month.
So what you're doing is putting the money into the whole life policies, keeping it there, and then tapping into it when you need it for other kind of investments.
Right. That's
So
exactly it.
you said it's a different topic, but why have you found, with all of your information and knowledge, and this is why I'm interested with your unique knowledge on this, that what you're doing now is better than it is in the stock market? Like, what do you have, what kind of rate of return do you get on what you're doing versus what you found there?
Yeah, so that's a good question. So as I mentioned, I was a financial advisor for a number of years. I actually sold mutual funds and IRAs and 401ks for a living. And the idea behind that, it's two fundamentally different schools of thoughts. So when I invest, I can invest for two things. I can invest for income, or I can invest for capital appreciation, meaning my money goes up in value versus it pays me a monthly income. And so when I look at those two different things, I've got to look at pros and cons. When I was a financial advisor doing mutual funds, it was mostly capital appreciation. It was, I'm going to dollar cost average every single month and put some money away into my funds. They're going to appreciate to a certain dollar amount or a certain nest egg. And when I'm, 50 or 60 or whatever my age, I'm going to start selling shares to produce income. And so with that style of investing, What's not factored into it is increased inflation and increased taxes, right? So if we call inflation, just to be conservative, let's call it a 3% average. If I buy a share of a fund, I have no control over whether or not it's going to go up 3%. I can't make it go up. There's nothing I can do. It's kind of just left up to chance. Now, the only thing I can do to offset that is I can save 3% more of my income every year, hoping I can keep up. Now, the first problem that creates is that creates a life of deferment. I'm putting off all of my living potential, my cost or my standard of living until I'm 60 or 65. It's all going towards that bucket. Now, the second problem is when I have that accumulation style of investing happen, when I hit my nest egg, I'm selling the shares to produce income. Now, if I sell too many shares too fast, I run out of money. Statistically, the average retiree will run out of money by about age 70. That's about a 10-year window that they've got. And so there's that risk of I can't control it if it doesn't go up in value. I've got to defer my lifestyle, and there's a very high chance of running out of money. Now, the second style, which would be income investing, is I buy assets that pay me every month. And that can be rental income. That could be small business equity where sales pay me and I'm maybe a passive investor. That could even be private lending where I charge an interest rate and I make money on that interest rate. Now, with that style of investing, I don't have to worry about whether or not I'm going to make money on it because it's something where it pays me every month. And if I have to outpace inflation, I can raise rent, I can increase my interest rate. If it's an equity deal, I can increase sales in the company and I can kind of offset that. And then when I do hit that nest egg or that point where I'm ready to start taking that as a distribution, I don't have to sell anything. My money will pay me every single month and I don't have to touch my principal value. And it kind of comes down to if I have the golden goose, why in the world would I kill it for a harvest when it's laying golden eggs? So those are the fundamentally different schools of thought. When you look at stock market investing over the last 20 years, this is a report from Dalbar, mutual fund rating company. The average investor made about a 3.88% annual return after tax or after fees and volatility before taxes in the last 20 years. And if you look at real estate investing, depending on the deal, a lot of mine I'm able to secure an 8 to 12% annual return as an income and still have that policy adding another 3 to 5% on top of that.
Makes a ton of sense. One of the things that I think is interesting is you talk about the paying off of debt. So do you think that paying off debt is a good or bad thing, and why?
So I think that's a very interesting topic. When I was a Dave Ramsey guy, that was the thing, right? Like aggressively attack debt. And I did that for a while. And so what I would have happen is and this is classic, like so many people will relate to this. I would aggressively hound at my debt, pay it, pay it, pay it. And because I was doing that, I would still be broke. I would have nothing saved. So what would always happen is I get about halfway through, car would break down. Guess what? I'm back in debt now. And so it's this cycle that people struggle with. And so what I realized is that paying off debt should be looked at as an investment. It requires capital. It has a yield. When I pay it off, I free up a monthly payment. That's kind of like cash flow. When I pay it off early, I save interest, which is kind of like the rate of return. And so just like any investment, I need to look at paying off debt as that. And I need to look at what's my cost of investing and what's the alternatives? What are the opportunity costs? Could I put this money elsewhere and earn a higher rate of return? So if I have a 25% interest rate credit card and it's costing me, $500 a month and I've got 10 grand or whatever it is on it, that's probably a good move. You look at that and say, okay, I can make 25% on this by paying it off. I can free up a $500 a month cash flow and it's only a $10,000 investment. I probably can't get that with $10,000 anywhere else. But if I've got, a car note and it's a $50,000 car note, my interest rate's 3% and it only costs me $300 a month. Like for sure, I could make 3% in a plethora of different places. So I think that's the mentality. The root cause of consumer debt, and this is so important that, I realized this a number of years ago, the root cause of consumer debt is lack of money. So paying off debt doesn't solve the problem. I've got to look at what was the root. I didn't have income and I didn't have savings. So if I aggressively attack my debt and I don't solve those two problems, it's almost 100% chance that I'm going to end up back in debt. So that would be my answer there. And then the other thing that too factors into it is, could I restructure? A lot of people don't look at, could I maybe do some balance transfers, or could I do maybe a different, term loan with a different interest rate? And those are different technical things that I'll help someone look at too on, could we connect you with somebody that does that? Because that could be a better answer where I can restructure the debt, keep my cash and go invest it still.
I think most people suck at saving money. I mean, that's just my opinion. You're the finance guy.
I
And
think
I
you're
think,
right.
401ks make it easy because a lot of the time it's auto deducted from the check, which I think is the only smart way to save money because you never see it. It goes away. It's like gone before you even get it. So what do you think
Yeah.
about 401ks? Because I know how your feeling is about the stock market, but like I said, I think a lot of people do it just because it's like it's the only self-control they have to try to save some kind of money. So what is your feelings about 401k? And, can you tap into a 401k you already have and reinvest those funds a better way?
So that's an excellent question. I just wrote an article on this probably a month ago. And so the 401k, people have kind of really adopted that, and it's very similar to the mortgage. Americans, for some reason, we're terrible at saving. There's a chart that I saw a number of years ago. It shows all the nations. We have the highest income rate and the lowest savings rate out of all the top 10 nations that were compared. And so the 401k is, like you said, it's an automated forced plan. I do believe that if most people didn't do that, they wouldn't have any savings because they're not paying themselves first and they're not using that financial discipline to make sure money goes aside. So I want to validate that aspect of it. For the average person, a forced savings plan is probably the best idea. Now, that being said, does the forced savings plan have to be the 401k? And that's what we need to look at. So, just to kind of go back a little bit, life insurance is the same way. Forced savings, I can have it go aside every single month out of my income, and it's an automated thing. So there's more options than just that. With the 401k, it was actually created in 1979 by a guy named Ted Benna. Ed made it just for his company. So it was not an IRS like Wall Street thing that everyone uses. It was literally just that company, and he used an IRS code to develop it. And they literally had like one or two funds. And so it was this very small scale thing. In the 80s, Wall Street got a hold of it and they really marketed it as a way to start getting more and more people into their products and services. At the same time, in the business world, there was kind of this phase where businesses that were guaranteeing pensions realized that they couldn't afford that. And so they were looking for a way out. And the 401k seemed to be the right way to do that. So this big push sent people into 401ks. Now, the bottom line with a 401k is that it's a deferred compensation plan. And it's important to know what that means. It means that when I put money in my 401k, I'm opting to defer, which means for something to happen later, my compensation, which is my pay or my wages. So I'm basically saying I'm going to opt to get paid later. The company match is the same thing. So a lot of people have this mindset: when I invest in the 401k, I'm getting a free match. It's actually not a free match. It's deferred compensation. That would have been my wage, but they're going to pay it to me later. Okay, so it's not actually free money. When employers were surveyed, they said it's a 90 cent on the dollar reduction in wages, every single dollar that's matched. So they're admitting we're reducing your pay to give you this match. Now, for the employer, they're getting the avoidance of payroll tax, and they still get the tax deduction. So it's kind of a nice deal for them. For me, I have to give up a dollar to get a dollar, but I'm actually not going to get either of those dollars till I'm 60, which they may or may not be there. The second factor is the tax deduction. So if I look at taxes, I'm getting a deduction on the front end, and that's very attractive. But the problem is that I'm foregoing long-term capital gains tax. So for those that don't know, if I were to just invest cash into any sort of investment, if I held it for longer than a year, I'm only paying long-term capital gains tax. That's a rate of 15%. Okay, if I'm in the top, tax bracket, it might be 20%. When I do the 401k, it's income tax. It's not capital gains tax, it's income tax. So if I have that money in there for the next 40 years and I pull it out, I'm paying income tax. And if we do the math, in 40 years, taxes will be higher than they are today. In 1913, the highest tax bracket was 7%. now it's 40%. So they're going to go up. It's inevitable. So I'm going to pay more in taxes, and it's going to be a larger sum of money. So the way that I like to explain the for like take IRS, I'm borrowing that money today and I'm going to pay them back later.
Makes sense. What about growing money tax-free? Possible and without legal penalties? Is that using whole life to do that, or is that possible to do?
It is possible to do. So the first thing is if somebody has like an existing 401k, one of my favorite things to do with that is you can roll that into what's called a pension trust. It basically just makes it to where you're the custodian and you're self-directing the account. So you could theoretically grow money tax-free and use that as a system of tax deferral and do stuff outside of Wall Street. outside of like retirement accounts, you can grow money tax-free in the 401 or in the whole life insurance as well. So the money that you're using in that account is tax-free growth, which is excellent. And that's one of my favorite ways to go about it. Outside of that, there's ways to deduct against gains. There's not a lot of other vehicles that are legitimately tax-free. So I could do real estate. For example, I do have gains, but I would just hope that I can defer and depreciate and deduct as much as I could against those gains. So there's not a lot of situations or scenarios where I just don't pay taxes. There are a lot of situations and scenarios where theoretically I would pay taxes, but because of tax rules and laws, I'm able to write those off or avoid those through just good tax planning.
Your company, Wealth Dynamics, what's the fastest way to fast track wealth? I imagine you guys know that. You do that pretty well.
Yeah. So when we work with clients, the first thing we look at is what do they have existing, right? So if you have a house, if you have a 401k, if you have assets built up, if I'm looking at that right now, that's money and wealth I've built that currently I probably don't make the bulk on. The institutions I have it with make the bulk on it. So how can I redirect those to where I have control of them? So one of the fastest things we do for people is if they have an old 401k, we usually will put that into like a self-directed pension trust. And now they're their own custodian and they're making maximum returns with minimum fees. One of my favorite plays, if someone has a mortgage, if they've got enough equity, we convert that over to a first lien home equity line of credit. They can start pulling their equity out, investing that and using that as their own financing source. And then the biggest one for me, Ty, is if you look at historically, there's a chart that I have actually. It shows the top 1% of wealth since 1913. They save 40% of their gross income. 40%, that's a gigantic amount. The average American, let's think about if I had to save 40%, I probably need to make at least 10 grand a month gross just to be able to have enough left over to pay my bills after. So the average person can't save 40% because when you think about taxes, debt, mortgage, 401k, I'm probably giving 50 to 70% of my income to financial institutions and I have nothing left after that fact. So the fast track really is, we teach people simplify money so it's easy to understand, but then also look at where am I losing it? Which institutions do I give it to and how do I cut them out so I can keep it and hit that 40% rule? And if I can do just that, just the 40% rule, I firmly believe somebody can build wealth in 5 to 10 years just by consistently doing that 40% rule and then investing it in wise investments that produce passive income.
Well, and that sounds great, right? But a lot of people can't do that because like our kids want to buy cool stuff. Like my daughter wants to buy a sled that goes down the stairs and that's awesome. Let's be honest. And a hoverboard and that's awesome. So a lot of us can't save 40% because we got to buy sleds and we got to buy hoverboards. So here's my next question. How do we increase our income? I mean, are there ways that we can increase our income then to give us more money to then put aside for those investments?
Yeah, that's an excellent question. So there's two schools of thought, and I think you kind of hit it on the head. There's the live below my means. I could budget harder. And I always tell my clients, like saving $3 a pound on hamburger meat is never going to make you wealthy. It just can't happen. So I do have to force my income up. So there's a concept I have that I teach my clients called the triangle of income. And this can apply to any person in any scenario. So the triangle of income goes like this. If you think of a triangle, the very top point would be knowledge. For me to increase my income, I have to have some sort of knowledge on some sort of area that makes me an expert and gives me the ability to help somebody. Whether that be finances, whether that be real estate, whether that be health, fitness, social media, marketing, doesn't matter what it is. I've got to have a specialized knowledge. The second point of the triangle is value. So I've got to be valuable, like intrinsically, my knowledge has to be valuable to others. It has to be something they want and need, and that's exchangeable in the marketplace. And then third, I've got to be an exchange, right? So if I'm not exchanging with other people, giving them ideas, giving them value, helping them, and really regardless of whether I'm being paid, I naturally would do that. That's going to result in me increasing my income. And that leads right into another thing we have called the triangle of wealth, which is earning income, saving that income, and investing that income. So if I can accelerate that through that triangle of income, of knowledge, value, exchange, that then increases my triangle of wealth, which brings me more income. I can now save more and I can now invest more.
Interesting. And interesting times we're in right now in 2020. So that being said, what are your financial concerns about what's going on right now in 2020?
It's very interesting. We've never had anything like this happen before. We've had depressions, we've had recessions. They've always been almost due to economic causes, war, different politics. Right now, it's health. It's the coronavirus pandemic, and so we have this unique situation where people are staying at home, and many of them aren't working. I saw a stat saying we have projected about 16 million Americans that are going to file for unemployment this month. Just huge stat. It's a lot of people. So the concerns that I have are more so like what's happening and what we're seeing with people on not being able to pay bills, going into forbearance on mortgages. What really is striking me on that is it's only been a month. And so what that tells me is the average American didn't have a month of savings set aside. They didn't have access to a line of credit to hold them over for a month. And what's crazy is that they did have your 401k, they did have their mortgage, they were doing all those things, and at the end of the day, those things can't help them right now. And so that's a really big concern I have for the individual that's listening to this. Is like, this is really Warren Buffett has this quote that said, when the tide goes out, you can tell who's been skinny dipping. And that really is what we're seeing now, is people are kind of being caught in a vulnerable spot where they weren't saving, they weren't focusing on their income, they weren't doing the right things financially, and it really put them in a at-risk position, so that when something like this happened, it became a catastrophe rather than an inconvenience.
Warren Buffett has the best quotes ever.
He does. I think he sits around and thinks of them.
He must, man. My favorite quotes literally come from Warren Buffett. Okay, so what about right now? What do we invest in? What assets right now in 2020 amid the COVID-19 crisis? Like what are the assets that you think people should be putting their money into?
Yeah, so that's an excellent question. So the first thing, and this is always in any scenario, I always tell my clients, your best investment is you. So if I have cash right now, especially if I'm not working, I'm investing to learn a new skill. I'm investing to learn something that's going to help me produce income. I have clients that are on Zoom meetings like we're doing now. They're doing business, they're closing sales, they're bringing in income, and it doesn't require them to leave the house. So I think even after this COVID thing, I think that's going to be a very, very attractive and very valuable thing. And most people are going to realize, hey, I don't actually have to leave my house to make money right now. So I would invest in skills that allow me to do that. As far as hard assets, right now I'm really looking at obviously whole life insurance as a point of stability and just accumulation. I'm doing a lot of gold and silver, like physical gold and silver bullion. And what I'm also looking at too is probably in the next 6 to 18 months, I think we're going to see real estate come down quite a bit. And so when that happens, I want to be ready for that. I want to be in a position where I can go buy assets that are on sale because I was stacking and accumulating, when everyone else was out spending and consuming.
Awesome advice. Awesome interview, Jerry. I mean, a lot of topics we were able to cover. As we get ready to wrap up, what should I have asked you that I didn't ask you so people can do the right things, take the right steps to accumulate wealth as responsibly and quickly as possible?
That's an excellent question. So I would say the first thing is really we have, kind of 3 points we look at. We look at purpose, then we look at wealth, then we look at freedom. And so for me, at least when I first started this, it was very hard for me to get traction because I didn't have my purpose. I didn't realize, like, why am I going to get wealthy? What's the reason behind it? And so I would look at that first as answering the question for myself that if I didn't have to trade time for money and I had 40 hours a week that I wasn't working, like, what would I be doing with my life at that point in time? And sure, the answer might be go on some trips and vacations, but I think most of us have a thing. We have like a passion, a purpose. We'd be like, man, if I could devote time to this, be that a business or a charity or a religious activity or whatever it might be, that's what we're on fire for. And that's the first thing. So that's huge. Second thing is look at what is my passive income number, right? So my passive income number, what would it take right now for me to have my bills covered, save 40% and cover my taxes? So the equation for passive income is passive income equals savings plus expenses plus 40% taxes. And that's the monthly number that I need to have. And based on that, I can really figure out where do I need to be at with my investing. And then thirdly, that's going to look at, like, what does freedom look like for me at that point? Like, how do I help other people once I am financially free and I do have that passive income? And I think if we hit those 3 things with the average person, it really gives enough of a roundabout picture on inspiration and also technical, like, what do I actually go do now to move the ball forward?
Jerry, thanks for coming in. Where can everybody go to kind of learn more and get more information from you?
That's an excellent question. So I'm on basically all social media. So if you look me up on Instagram, Facebook, LinkedIn, Twitter, at Jerry Fetta. And then also, if you go to my website, jerryfetta.com/info, jerryfetta.com/info, there's a graphic there that actually gives an exact step-by-step plan to do all of the things I talked about today with building wealth. That'd be an excellent place to start.
Perfect. Jerry, thanks for coming in with us today.
Thank you so much, Ty. I appreciate it.
So guys, we just ran out of time. I mean, there's so much more we could go over with Jerry about wealth building strategies, and he just scratched the surface. And I don't know about you, but my head is spinning. Like I have to go reevaluate my entire strategy now after this call. But there's so much more information on both of Jerry's websites, on wealthdynamics.com as well as jerryfetta.com. So make sure you go to jerryfetta.com/info to get that infographic, to get some details, to basically see the truth that you don't know about money, and to be able to learn a lot of things that can increase your wealth. So that's jerryfetta.com/info. Make sure you visit it today.